The most dangerous phase in a market cycle is rarely the moment everyone is terrified. It is the moment everyone starts feeling rich again before the system is actually healed. That is when people stop asking hard questions. That is when discipline begins to look old-fashioned. That is when weak balance sheets start behaving like strong balance sheets simply because prices become generous again. And that is why I have always distrusted a melt up far more than an honest panic. A panic at least tells the truth about fear. A melt up tells a far more expensive lie. It tells people that price and safety are the same thing. They are not. That distinction matters even more today because people are once again building a story around the Federal Reserve that is emotionally satisfying and strategically incomplete. The story goes like this. If the Fed stops cutting, risk assets should struggle. If inflation is still a problem, markets should be cautious. If oil rises, consumers feel worse, and rate relief disappears, then surely stocks, housing, and other speculative assets should calm down. Reasonable story, clean story, and wrong often enough to cost a great many people a fortune, because markets do not move only on the world as it is. They move on liquidity, positioning, hope, short covering, future easing fantasies, and the very human desire to own tomorrow even while today still looks ugly. That is how melt-ups happen, not in defiance of bad news. In coexistence with it, the world remains strained, but asset prices rise anyway. The bill has not disappeared. The party just moved to a room with better lighting. That is the phase I think we are looking at now, or at least the phase the market is trying very hard to price. And if you do not understand it, you are likely to make one of two bad mistakes. You either sell too early, because the fundamentals still look too messy to justify the rally, or you become euphoric too late because the rally itself starts feeling like proof that the fundamentals no longer matter. Both errors come from the same misunderstanding. They confuse price with resolution. Resolution is when the problem gets solved. Price is what people are willing to pay while imagining it will be solved later. Those are not the same thing. Never let a rising market persuade you that a rising market is the reason it deserves to rise. That is circular thinking. A lot of people need to hear that right now because the Federal Reserve just reminded everyone that inflation still matters, that cuts are not guaranteed, and that policy restraint can last much longer than the crowd wants. The FOMC statement on the 29th of April, 2026 said the target range for the federal funds rate would remain at 3.5% to 3.75%, and recent market reporting after that meeting shows traders sharply scaled back expectations for 2026 cuts. Faysite Fayturn 419,902 search 2 Fayturn 419,902 news 38 Fayturn 419,902 news 37 Fay. That should have been enough to produce a calmer tone. It was not. And that tells you something. It tells you the market is not trading the present in the way ordinary households live it. It is trading a complicated mix of future easing, persistent nominal growth, liquidity adaptation, and the simple fact that large pools of capital often prefer owning things to holding caution. This is where many ordinary investors get emotionally lost. They hear no cuts and they expect no rally. They hear inflation pressure and they expect no risk appetite. They hear consumer sentiment is weak and they expect everyone should be defensive. That is not how the machine works. The machine is stranger than that. It can push stocks higher while people feel poorer. It can push home prices higher while affordability is awful. It can push Bitcoin higher while the same people buying it insist the economy is broken. That is not a contradiction. It is the market expressing a preference for nominal escape. When money gets uncertain, people often do not run toward clarity. They run toward ownership. Any ownership stocks, homes, gold, Bitcoin, private businesses. Anything that looks like a claim on something scarcer, stronger, or more dynamic than cash. That is one of the core truths people miss about late cycle market rallies. They are not always saying the economy is wonderful. Sometimes they are saying something much darker. They are saying, I would still rather own assets than sit in money while the system remains unresolved. That is the beginning of a melt-up mentality, not confidence escape velocity. You can see this more clearly if you stop asking whether the average person feels optimistic and start asking what the market is actually pricing. The market is not a consumer survey. It is not a diary. It is not a moral report card. It is a forward auction full of frightened, greedy, overfunded, underhedged benchmark, chasing highly incentivized institutions trying to own the future before it becomes obvious. That future may turn out to be wrong. But price moves long before certainty arrives. In fact, certainty is what prices tend to charge the most for. That is why the strongest rallies often feel the least emotionally justified. When things are comfortable, prices are usually already comfortable too. When things are uncomfortable, price can still be cheap enough to produce tremendous upside. If the discomfort proves survivable, the investors who sold during the worst pain are always the last to accept this. They wait for proof, but proof arrives in the form of higher prices. Then they tell themselves the move is irrational. Sometimes it is simply earlier than their emotions wanted it to be. This is where the Federal Reserve becomes such a dangerous object of worship in market psychology. People imagine the Fed is the whole script, as though every rally begins with a cut and every decline begins with a hike. That has never been true. The Fed matters enormously, but the market always prices more than the current rate. It prices expected future rates, expected future liquidity, expected future earnings, expected future rescue, expected future inflation, and the simple possibility that nominal assets may continue floating higher even while the foundations remain uncomfortable. That is why a melt-up can begin under conditions that look absurd to anyone demanding a clean macro narrative. If rate cuts disappear this year, but investors still believe the next easing cycle is merely delayed rather than canceled forever, they can still push risk assets higher. If inflation remains sticky but nominal revenues remain strong enough to support earnings, they can still push stocks higher. If households feel miserable but institutions believe the misery will later become policy support, they can still push markets higher. This does not mean the markets are wise. It means they are anticipatory, and anticipation, especially near the end of a cycle, can become self-reinforcing. A rally begins. People who sold under fear feel wrong. Short sellers get squeezed institutions, underweight risk chase exposure. Retail investors who missed the first move begin buying the second one. The narrative shifts from "this is dangerous" to "this is the beginning of something bigger." And then the most expensive sentence in finance arrives: what if this time really is different? That sentence has separated more people from more money than almost any other. Now, let me explain why this environment is especially tricky. Oil is rising again. That matters because energy is one of the few inputs that can work its way into almost everything else. Reuters reported this week that traders have started pricing less chance of Fed cuts and more chance of a hike by early 2027, partly because of persistent inflation risks. When oil and broader input costs stay firm while policy is on hold, the market does not get the clean disinflationary backdrop it wanted. Fay-site Fay-turn 419,902 news, 38 Fay-turn 419,902 news, 36 Fay at the same time. The Federal Reserve has not delivered the easy money signal the crowd wanted. The official statement kept the target range unchanged, and Powell's current chair term is set to end on May 15, 2026, based on the Federal Reserve's own record of his term. Meanwhile, the White House announced Kevin Warsh's nomination on the 30th of January 2026. That means there is a leadership transition story layered on top of an unresolved inflation story, layered on top of a market that has already started behaving as though the future will be easier than the present. Fay-site Fay-turn 419,902 search 2, Fay-turn 419,902 search 0, Fay-turn 419,902 search 1 Fay. That combination is combustible. Not because it guarantees a crash tomorrow, because it creates the perfect environment for price to outrun understanding. And when price outruns understanding, people start building identity around the rally. The stock market is up. Therefore I was right. Bitcoin is recovering. Therefore it was obvious. Housing is still sticky. Therefore affordability must not matter. Number a melt up does not prove a sound system. It proves an eager system. Those are different. A sound system can withstand disappointment. An eager system desperately needs the story to keep improving because the valuation already moved ahead of the comfort. That is why the final phase of a cycle often feels so seductive. Everyone looks richer, but the richness is built on increasingly fragile assumptions, and still, I do not think the correct response is panic. This is where so many people go wrong. They hear a warning about melt-ups and conclude that the wise move is to sell everything, hide in cash, and wait for clarity. That is usually just another emotional extreme. The investor who sells simply because the market feels too strong is often just repeating the opposite mistake of the investor, who buys simply because the market feels strong. Both are reacting to sensation rather than structure. Structure is what matters. So what is the structure here? The structure is that the Fed remains restrictive by recent standards. The market remains willing to bid risk assets. Anyway, policy relief is delayed, not fully dead in the imagination. Nominal growth still matters more for asset pricing than consumer misery does. And large pools of capital remain unwilling to abandon ownership simply because the headlines remain ugly. That structure is not a reason to sell blindly. It is a reason to invest with humility and respect for where we are in the emotional arc. I always tell people that there are three very different ways to behave during a melt. The first is the stupid way. You chase whatever has already gone vertical because you feel left behind and cannot tolerate watching others make money. This is how people end up owning the weakest assets at the most dangerous prices. The second is the frightened way. You abandon all exposure because the rally feels absurd, then watch prices keep running without you, and later re-enter from a place of embarrassment rather than conviction. The third is the grown-up way. You admit that markets can remain irrational longer than your need for narrative comfort. You keep investing, you stay diversified, you refuse to lever yourself into fashionable trades, you let your asset allocation do its job, you respect momentum without worshiping it, and you remain emotionally prepared for the possibility that the rally can continue much longer than it deserves, while also being ready for the moment the bill finally appears. That is the only behavior I trust. Not because it is exciting, because it survives more states of the world. And survival is a vastly underrated quality in investing. Too many people want to be right. Far fewer want to be durable. Durability matters more. A durable investor can live through the melt, up through the correction, through the inflation scare, through the missing rate cuts, through the surprise easing, through the policy transition, and through the part where everybody claims afterward that it was obvious all along. Nothing is ever obvious all along. The market only makes the path look obvious after it has already punished anyone who demanded proof before participating. That is why I keep coming back to the same lesson. Do not build your financial life on the assumption that you can correctly time the emotional phases of a market. You cannot, neither can I. Neither can most professionals who speak with tremendous confidence on television. What you can do is this. You can stop pretending that bad news must automatically produce lower prices. You can stop pretending that a rally must automatically mean the problem is solved. You can stop worshiping rate cuts as though they were the only source of upside. And you can stop treating late cycle wealth effects as if they were the same thing as durable wealth. That last point is crucial. Melt-up wealth is not the same as secure wealth melt. Up wealth is to market optimism. Secure wealth is what remains after volatility, taxes, leverage, and your own emotions have all taken their turn. Those are very different fortunes. I have seen many people get rich on paper during the last exuberant stretch of a cycle, only to discover they were not actually wealthy because they had organized their whole life around prices continuing to do the only thing they had recently done, which was rise. That is not wealth. That is dependence on momentum. I do not want that for you. I want something calmer, own good assets. Keep buying steadily. Accept that rallies may continue without your moral approval. Accept that corrections can arrive without your permission. Refuse to make giant moves because one Fed meeting seemed obvious. Refuse to assume that a leadership change at the Fed automatically means easier money on your preferred timeline. Refuse to let temporary price strength convince you that fragility has disappeared. And above all, remember that the final stage of a cycle is usually the moment when discipline feels most unnecessary. That is exactly when it becomes most valuable, because markets love to seduce people right before they humble them. They make you feel brilliant at the precise moment. Your need to keep feeling brilliant becomes dangerous. That is the emotional signature of a melt. Up not just rising prices, rising self-confidence attached to unresolved reality. When you see that, do not panic, do not worship it, do not marry it, just understand it. Understand that the Fed can hold rates steady, cuts can vanish, oil can remain a problem, consumer confidence can stay weak, and assets can still levitate because the market is pricing a future that has not yet been earned. That is not a contradiction. It is the machine doing what the machine has always done. Borrowing tomorrow to revalue today, sometimes that bet is justified. Sometimes it ends badly. Either way, the investor who keeps his head tends to do far better than the one who lets the temperature of the market become the temperature of his own mind. That is the whole lesson. The melt-up may continue. It may reverse sooner than people think. It may mutate into something stranger. I do not know, but I know this much. The worst reason to buy is because the rally made you feel safe, and the worst reason to sell is because the rally made you feel uncomfortable. Safety and discomfort are emotional categories. Price is a market category. Never let one pretend to be the other. That is how you survive the last hot phase of a cycle. Not by guessing perfectly, by refusing to let the heat make you stupid.